Good morning. I am Lakshmipathy AMG, Assistant Professor of Commerce, Government, First Grade College, Madhugiri, Tumkur District, Karnataka State. My title is Financial Accounting 2. I am discussing about the topic fire insurance claim in session number 1. In session number 1, the topic is covering meaning of insurance, meaning of insurer, insured, underinsurance, overinsurance, and salvage. So, first we know the meaning of fire insurance. A fire insurance contract is a contract of indemnify under which one party called insurer undertakes to indemnify, that is compensate, the other party is called insured for the loss suffered by the latter, that is insured, and the happening of some contingent event in consideration of a payment is called a premium. So, fire insurance means insurance against any loss caused by fire. So, according to section 2 subsection 61 of the Insurance Act defines fire insurance business means the business of effecting, otherwise then incidentally to some other class of business, contracts of insurance against loss by or incidental to fire or other occurrences customarily included among the risk insured against in fire insurance policies. The term fire insurance refers to a form of property insurance that covers damage and losses caused by fire. So, fire insurance is a contract to indemnify the loss suffered by the insured. This contract does not help in controlling or preventing fire, but it is a promise to compensate the loss. A fire insurance is an agreement between two parties. The one party is called insurer and other party is called insured, whereby insurer undertakes to indemnify the loss suffered by the insured in consideration for is, that is insured, paying of certain sum called premium. So, fire insurance is a contract of indemnity. The insurer is liable to only to the extent of the actual loss suffered. If there is no loss, there is no liability, even if there is a fire. Fire insurance is a contract of good faith. The policyholder and the insurer must disclose all the material facts known to them. So, fire insurance policy is generally made for 1 year only. So, what are the characteristics of fire insurance claim? The following are the characteristics of fire insurance claim. Fire insurance is a contract of indemnity. The insurer is liable only to the extent of the actual loss suffered. If there is no loss, there is no liability, even if there is a fire. The second characteristics of fire insurance claim: fire insurance is a contract of good faith. The policyholder and the insurer must disclose all the material facts known to them. The third characteristics is fire insurance policy is usually made for 1 year only. The policy can be renewed according to the terms of the policy. The contract of insurance is embodied by a policy called the fire policy. Such policies usually cover specific properties for a specified period. Next characteristics: insurable interest. A fire insurance policy is valid only if the policyholder has an insurable interest in the property covered. Such interest must exist at the time when the loss occurs. In English cases, it has been held that the following persons have insurable interest for the purpose of fire insurance claim, that is owner, tenants, bailey, including carriages, mortgages and charge holders. In case of several policies for the same property, each insurer is entitled to the contribution from the others. After a loss occurs and payment is made, the insurer is subrogated to the rights and interest of the policyholder. An insurer can reinsure a part of the risk. Next, what is the meaning of insurer, or who is the insurer? So, insurer is a person who agrees to bear the risk of loss arising on account of loss of stock, property, profits, etc. due to calamities and compensate such loss is called insurer. Insurer is an individual or company who, through a contractual agreement, undertakes to compensate specified losses, liability, or damages incurred by another individual. An insurer, frequently an insurance company, and is also known as an underwriter. An insurer is a company who sells the insurance policies. Insurer is the one who bears the risk in return for consideration, which is known as premium. Insurer agrees to pay the insured a certain sum of money if the insured peril occurs, so that it is possible to continue the benefits. Who is insured? Insured is also a person who has suffered loss and shifts to the insurer is called insured. An insured is a person who is the buyer of the insurance policy. An insured is the proposer of the policy, who pays premium as the consideration to the insurance company. Insured purchases the insurance policy to safeguard the assets from the financial consequences of losses or damages that occur from the insured peril. Next, what is the meaning of underinsurance? So, underinsurance refers to when the amount of insurance cover is less than the actual value of the insured stock is called underinsurance. Underinsurance is to purchase an insurance policy for the value less than the actual or market value. Most of people are tempted to save on part of paying monthly premium. Higher the insurance amount and higher the amount of premium, keeping this fact in view and without going into the details of agreement of insurance, that is insurance policy. People mostly on the advice of insurance broker opt for the underinsurance without keeping in mind the final consequences of such underinsurance. So, underinsurance is when the amount of insurance is covered less than the actual value of the insured items. It may also be less than the replacement value of the insured items. For example, if a property of the actual and market value of goods for rupees 1 lakh is insured for rupees 50,000 only. So it is a case of underinsurance. In such a case, the insured shall be required to pay the premium for sum assured of rupees 50,000 only in place of rupees 1 lakh. Naturally, the amount of premium shall be less than what was required to be paid had the property been insured for full value of rupees 1 lakh. Sometimes underinsurance is done voluntarily and willingly, but in many cases it can be ignorance or inability of insured to estimate the true and market value for replacement of insured property in case any loss or damage caused to the property. So, underinsurance is neither be beneficial to the insured nor to the insurance company. Both are losing. In case of any major disaster to the insured property, because of any reason, the insured person shall not be compensated with full value, and only the sum amount insured shall be paid by the insurance company, which shall not enough to replace the lost property or items. On the other hand, the insurance company remains at loss for being unable to receive the required amount of premium. Most important factor for insurance company is the fact that they find it difficult to settle claim for underinsurance cases, which adversely may affect the reputation. In matter of settlement, an average insurance claim of any underinsured property, the insurance company applies the principle of average. Then next we know the meaning of overinsurance. Overinsurance means if the insured amount is more than the actual value of the insurable stock is called a overinsurance. In case of overinsurance, a situation arises where insurance cover has been taken for the value which exceeds the actual cash value of the insured risk. It can be also known as the replacement value. In case of overinsurance, the insurer companies have to be very careful at the time of selling the insurance policy. The insurance company, in case of overinsurance, can bear much losses as the insured may be tempted to make false claims with a view to gain profit from the loss insured at overvalue. Overinsurance results into compensation to be paid by the insurance company in excess of the actual loss incurred by the insurer, either by false claims or due to overvaluation of the insured assets. Many insurance companies have lately devised methods to prevent overinsurance, particularly in group health insurance or mediclaim insurance. Recently, in India, it was observed that certain hospitals in convenience with TPS of respective insurance companies are staking claims for medical treatment of insured persons at much higher rates, because of which many insurance companies are facing loss. With the result, many insurance companies have stopped cashless facilities because of this reason. These companies are bent upon to decide some basic modalities to provide cashless medical insurance. For example, if some gets insurance of a factory valued rupees 1 lakh for rupees 1,50,000, it is over insured. But in case of any mishappenings, the insured must be under the impression that he would be compensated for the amount insured, that is rupees 1,50,000, and shall gain the profit of rupees 50,000. But coming down the actual grounds, it is found that the insurance company has its own methods to gauge the loss actually incurred and shall be liable to pay the market value of the loss only, which is rupees 1 lakh only. In such cases, the insured forgets that he had been paying premium at the more higher rates instead of actual rate of premium per month. So, in case any loan has been raised from any bank or financial institution, it shall create more problems, because due to the inflated inventory submitted to the bank, the loan amount might have increased, whereas the actual value of the insured stock is less than the amount of loan. So, in such cases, the insurance company shall first pay to the bank or financing company, and the remaining amount shall be borne by the insured for obtaining insurance cover over and above the actual market value. So what is next? We know the meaning of salvage. So what is salvage? Salvage refers to the goods are saved from fire, are protected from fire. So if any amount of claim to be calculated, that time the what we are saved from fire, that amount of goods are we are deducted from the value of stock at the date of fire. These are the so now at the at this time we are ending the first session. So first session we are covering, we are discussing the introduction, meaning of fire insurance claim, meaning of fire insurer, insured, underinsurance, overinsurance, and lastly the salvage. So in this, so finally revision. In this fire insurance claim, there are two parties, agreement between the two parties. One party is called insurer and another one is insured, whereby one party is agrees to indemnify the loss suffered by other party and the happening of certain contingent events. So and finally some part of goods were saved from fire, that is called salvage, and finally reference. So thank you very much.